You think the crash of 1929 was a mistake, a fluke, a historic anomaly that belongs to sepia-toned photographs and dusty textbooks. But you are wrong. What happened on those final October days was no accident. The floor fell out from under the world's elite. Brokers clawed at their desks. Phones rang off the hook with desperate whispers. Men who had once counted themselves untouchable found themselves staring into the abyss. And yet most people, maybe even you, still don't know who engineered it or why. It started with the smell of money, stale tobacco, ink-stained ledgers, the faint tang of fear in the air. On the surface, it looked like a roaring market. Everyone was getting rich. Ordinary Americans bought stocks with the same confidence they once reserved for refrigerators and automobiles. Banks encouraged it. Newspapers celebrated it. Wall Street glittered like a carnival, the lights blinding anyone who dared look too closely. But underneath that glitter, an invisible architecture was being built, a system designed not to create wealth, but to engineer panic. The architects were not nameless. They were men who saw markets as a game, as a chessboard, as a stage for hubris. Charles Mitchell at National City Bank, Richard Whitney at the New York Stock Exchange, and a cabal of private bankers, men whose fortunes dwarfed entire industries, knew exactly how to manipulate the narrative. They understood the power of fear, the leverage of margin loans, the way rumors could move billions overnight. Margin trading had exploded by 1928. Ordinary investors, with savings often smaller than a single stock purchase, were borrowing up to 90% of their investment. It was brilliant in theory, until the dominoes began to fall. And fall they did. But here is the shadow most textbooks omit. The panic was engineered to liquidate specific holdings. There were targets, industries, banks, and brokers that needed to be sacrificed so that the few at the top could consolidate unimaginable power. You might ask, how could this happen? How could the Dow Jones, an index you trust to reflect reality, be so carefully manipulated? It was simpler than most imagine. The architects played a long game. They orchestrated sell-offs during moments of irrational exuberance, whispered catastrophic predictions to select journalists, and timed bank announcements to coincide with market downturns. Every public panic had a private author. Every crash left a signature. In July of 1929, a strange pattern emerged. Heavyweights in finance began quietly liquidating their positions in large industrials. The average investor, intoxicated by easy credit, saw the same stocks rising and believed the boom would last forever. Meanwhile, behind closed doors, the shadow players were betting against their own friends, their own companies, their own public image. A house of cards was being methodically dismantled, piece by piece. By October, the illusion of prosperity had become a trap. On the 24th, Black Thursday, the first tremors struck. Heavy selling hit $13 billion in stock value, a number that sounds small today, but was seismic in 1929. Brokers begged wealthy clients to lend cash. Banks scrambled to cover their shorts. And here is the hidden variable most history books skip. The Federal Reserve had been quietly raising interest rates months earlier. They claimed it was policy, but it was leverage. Every rate hike was a dagger to the margin accounts that fueled the speculative frenzy. The weekend that followed Black Thursday was a crucible. Secret meetings in Manhattan offices, smoke-filled rooms, and private clubs determined which firms would survive and which would be annihilated. And you have to understand, the architects did not panic. They thrived. Men like J.P. Morgan, who is remembered as a stabilizer, were in fact orchestrating block trades to concentrate wealth while public perception blamed the market. When Monday came, the chaos escalated. Black Monday, October 28th, the Dow lost 13% in a single day. The following day, Black Tuesday, the floor of the exchange seemed to vibrate with collective despair. Investors screamed, brokers collapsed, banks teetered on the edge of ruin. And still, the shadow players remained unseen, collecting the remnants of a world they had carefully designed to fail. It is tempting to think this is history, but look at 2026. Look at AI investment frenzies, leveraged crypto derivatives, and central bank digital currencies quietly being rolled out. The same mechanics are at play: leverage, panic, and the illusion of infinite growth. You are standing on the edge of a digital Black Thursday, and most people don't even realize it. Even the heroes of the time were complicit. Richard Whitney, elected president of the NYSE in 1930, was a man who would later be jailed for embezzlement. But his actions in 1929 were far more sinister than the crime that made him infamous. He led a campaign of selective reassurance, making public statements to stabilize the market, while secretly collaborating with the architects of panic. Every press release, every staged intervention was calculated to protect some and sacrifice others. The architecture of the crash depended on three pillars: credit, confidence, and concealment. Credit gave leverage, confidence made the public buy blindly, concealment allowed insiders to profit while the masses suffered. And here is the secret: the most damaging pillar was concealment. Without knowing who was pulling the strings, ordinary investors acted on instinct, fear, and rumor. Panic became a contagion because the source of the panic was invisible. By the end of 1929, billions of dollars had evaporated. Entire banks failed. Families lost life savings. The real economy began to contract as the financial system collapsed under its own weight. And yet, while the public blamed the market, the architects had already moved on. They invested their winnings abroad, diversified into foreign bonds, and waited for the next cycle. They had engineered not just a crash, but a pattern, a repeatable method of wealth extraction. Consider this: the Dow Jones didn't just fall, it was meticulously engineered to break. Every spike, every drop, every rumor had a purpose. The architects understood human psychology better than economists or journalists. Fear is programmable, greed is predictable, and history has shown that these lessons are cyclical. 1929 was merely the blueprint. Look at today's 2026 economy. Household debt is at record highs. Margin trading has returned in new forms: derivatives, AI-powered trading bots, and leveraged ETFs. The same vulnerabilities that brought the Dow to its knees are alive again, only faster, digital, and more opaque. And the shadow players? They are invisible once more, not sitting in smoke-filled rooms, but coding algorithms that will execute the panic automatically. The scale is unimaginable. The outcome may be identical. But there was a moment in 1929 when a handful of bankers considered halting speculation, raising transparency, or curbing leverage. They chose hubris instead. They assumed control meant immunity, and that hubris is timeless. Every cycle since has repeated that fatal error. You are watching history, but you are also living it, and understanding the architecture of panic is no longer academic, it is survival. The tragedy of 1929 was that the masses never saw the strings. They saw numbers, they saw charts, they trusted the system. But what if the system itself was a weapon? What if every crash is less about economics and more about engineered psychology? Ask yourself, in 2026, how many people are counting on numbers they don't understand? How many fortunes depend on panic that is waiting to be unleashed?
Even the so-called regulators were actors in the Greek tragedy. The Federal Reserve, Congress, and the SEC's precursor agencies were either unaware or unwilling to confront the shadow players. Meetings took place behind closed doors, data was withheld, and policy lagged behind market movements. Meanwhile, the public continued to buy, believing they were participating in prosperity. And here is the cruelest irony. The crash appeared spontaneous because it was invisible, yet it was precise, engineered, calculated, and optimized for maximum social and financial disruption. By late 1929, the Dow had lost nearly 90% of its value from the 1929 peak. Unemployment soared, breadlines formed. The psychological fallout was immense. People who had believed in the American dream were left questioning reality itself. And that's the lesson that echoes into 2026. Engineered panic is not just financial, it is psychological, it is societal. It shapes belief, behavior, and trust. The hidden variable, the one you will rarely hear discussed, was timing. The architects of panic understood that markets are as much about...
The architects did not simply profit, they rewrote the rules. They demonstrated that financial collapse was not chaotic, but programmable. Every panic leaves traces if you know where to look. Suspiciously timed block trades, insiders quietly liquidating while the public buys, and financial narratives carefully sculpted for maximum panic. In 1929, it was banks and industrial magnates. In 2026, it is hedge funds, AI trading algorithms, and global digital asset platforms doing the same dance at hyperspeed. Take the story of Richard Whitney again. Publicly, he became the face of stability. Privately, he was a conduit, moving massive sums at exactly the right moment, ensuring the engineered collapse reached full velocity. There were moments when he could have stopped it, moments when transparency could have saved countless lives, but the opportunity was sacrificed for profit and reputation. The lesson is brutal. In financial systems, the appearance of authority is often more powerful than the authority itself. The psychological blueprint of panic is deceptively simple. Fear spreads faster than reason, greed blinds, leverage magnifies, and the architecture of 1929 was built to exploit these human flaws with surgical precision. Ordinary investors thought they were making independent choices. In reality, their decisions were anticipated, guided, and amplified by forces they would never see. This is the hidden variable that repeats in every major crash. Human psychology is predictable, and when engineered correctly, unstoppable. Fast forward to 2026. Digital wealth platforms allow near-instant buying and selling. Social media fuels FOMO, fear of missing out, creating real-time contagions of greed and panic. Central banks issue digital currencies that can be manipulated algorithmically. Margin accounts exist in ways the 1929 brokers could only dream of. Shadow players no longer need to whisper in private clubs. Their influence is embedded in code, executing trades at machine speed, triggering cascades of liquidations that mimic the panic of a century ago, but without the human intermediary. Even now, ordinary investors are walking into the same trap. You are likely exposed to risks you cannot quantify, invested in instruments that can collapse in seconds, and relying on signals that are crafted for you to react emotionally. The past is no longer past, it is accelerating, and every lesson ignored is a weapon loaded against you. But the crash of 1929 also had a subtler layer, the villainous choreography of public perception. Newspapers reported numbers, but they did not report strategy. Brokers spoke in coded language, while analysts praised the market as if it were infallible. The illusion of stability is a critical tool of engineered panic. When you believe the system is sound, your actions accelerate its failure. And that is why even decades later the lesson is being repeated. Trust in public information can be fatal when the system itself is designed to mislead.
Consider the banks. Many of them failed, but those that survived did so not by virtue of prudence, but because they were part of the orchestration. The architects ensured survival for those aligned with their interests and destruction for those who were not. It was selective devastation, a market culling dressed as indiscriminate collapse. And today, in 2026, similar patterns are emerging. Megabanks, tech conglomerates, and hedge funds have positioned themselves to profit from the downfall of smaller competitors using derivatives instruments, AI trading, and opaque digital assets. The strategy is identical, only the speed and scale have changed. And yet, even as the Dow crashed, ordinary citizens clung to hope. They bought more stocks on margin, believing the worst was over. Some were bailed out by friends, family, or surviving banks. Others lost everything. The psychological trauma was generational. This is the power of engineered panic. It is not just financial destruction. It leaves an imprint on behavior, risk perception, and societal trust. In 2026, behavioral patterns are repeating, with AI-driven sentiment analysis detecting microtrends in fear and greed, turning panic into profit before the majority even realizes a threat exists. The shadow players in 1929 were human. In 2026, the shadow is both human and algorithmic. Complex networks of trades, bots, and predictive models can simulate panic, amplify it, and direct it toward predetermined targets. The illusion of randomness is deliberate. When a digital platform flashes red, when a social media trend erupts, when liquidity suddenly vanishes, the same invisible hand is at work. It is engineered, it is intentional, and it is designed to leave billions exposed. Yet the lesson of 1929 was never about the mechanics of the crash alone. It was about hubris. Those who believed themselves untouchable, Mitchell, Whitney, and others, overestimated their control. They assumed that their influence could prevent consequences from cascading beyond their walls, and when the collapse hit, some fell faster than the public. Even the orchestrators are vulnerable to systemic feedback. Hubris, it seems, is timeless. By the end of 1930, the American economy was transformed. Industrial production had plunged. Unemployment reached historic highs. Families starved. Banks were shuttered. The psychological impact lasted decades, and through it all, the architects remained largely anonymous to the public, while the narrative framed the event as a natural market failure rather than a carefully choreographed collapse. This is the cruel genius of engineered panic. Society remembers the numbers, not the manipulators. Look at the pattern: 1929, 1987, 2008, 2020. Each crash has its own causes, its own headlines, its own public villains, but the underlying architecture is the same: leverage, human psychology, secrecy, and selective intervention. The instruments evolve, the platforms change, but the method persists. And now, in 2026, the architecture is digital, global, and instantaneous. The stakes are higher than ever. Here's what's most chilling. The architects are no longer limited by geography, by regulatory oversight, or by communication speed. The tools at their disposal, algorithms, AI-driven predictive trading, digital currencies that can be manipulated algorithmically, allow them to orchestrate panic on a scale previously unimaginable. Every trade, every tweet, every algorithmic signal can be a vector for engineered collapse, and the majority of people, maybe even you, are completely unaware of the invisible strings guiding every decision you make. Consider leverage once more. In 1929, it was buying stocks on margin. Today, leverage exists in derivatives, in cross-platform lending, in digital tokens whose value is pegged by algorithmic promises. Collapse can propagate faster than humans can comprehend, and as history shows, the moment panic becomes contagious, it is unstoppable. There is no warning, only reaction. The difference between 1929 and 2026 is not method, it is speed. By the time the public realizes a threat, billions are already at risk, and the architects, human, algorithmic, or hybrid, have already profited, insulated, and moved on. The question is not whether another engineered panic will happen, but when. And when it does, it will be faster, more pervasive, and more devastating than anything the 20th century could have imagined. The terminal lesson is brutal. History does not repeat, it accelerates. What was once a crash that took months to unfold can now happen in hours. What once took weeks to ripple through a population now spreads globally in minutes. And those who do not recognize the architecture of panic, who do not understand leverage, psychology, and concealment, are the most vulnerable. You are watching the peak, but the drop is already programmed. In 1929, the Dow Jones was a symbol. Today, the symbols have changed. Indices, digital assets, AI-driven trading platforms, but the mechanisms are the same. Panic can be engineered, fear can be monetized, trust can be weaponized, and if you do not understand the blueprint, you risk being a casualty of a cycle that has been repeating for nearly a century, now at its fastest, most dangerous velocity yet. You may feel safe, you may believe technology protects you, but the crash is no longer just about numbers, it's about perception, algorithmic manipulation, and human emotion. The architects of panic have evolved, and so must your understanding. The only way to survive the next engineered collapse is to see the strings, to question the narratives, and to anticipate the moves of those who profit from fear. And when it comes, because it will, you will realize that history was never about the past, it was always a warning for the future.
The next crash will not be televised. It will arrive silently, in lines of code, in algorithms executing billions of dollars of trades before humans even know what is happening. Social sentiment will spike, digital assets will tumble, derivative positions will unwind automatically, and by the time news feeds flash warnings, the architects will already have collected their spoils, just as they did in 1929. The pattern is undeniable. Panic is programmable, and those who understand it wield godlike power over billions. Look closely at 2026's shadow players. They are hedge funds moving millions across borders in milliseconds, AI algorithms detecting fear before it is consciously felt, and private banking networks quietly liquidating positions to shape markets without leaving fingerprints. Unlike the men in Manhattan offices of 1929, today's operators are invisible, yet the method is identical. Manipulate perception, leverage human psychology, control timing, and conceal intent. History has taught us the blueprint, but technology has upgraded it. Even central authorities, the supposed guardians of stability, are enablers. The Federal Reserve, the Bank of Canada, the ECB, they set rates, monitor liquidity, and intervene publicly, but markets now operate faster than policy can react. And in the spaces between, algorithms, bots, and shadow networks exploit every gap. They do not make mistakes, they do not hesitate, they do not panic. They execute with the precision of centuries of financial warfare distilled into code. Consider leverage again. In 1929, it destroyed ordinary Americans who bought on margin. Today, leverage is embedded in complex financial instruments that most people cannot even begin to understand. AI-driven options, leveraged ETFs, synthetic derivatives, decentralized finance networks. Collapse in these systems is not gradual, it is exponential, and the same principle applies. The higher the leverage, the faster the panic spreads, the more catastrophic the fallout. And the psychological traps remain. Greed blinds, fear paralyzes, panic spreads like a contagion. The difference is the scale. In 1929, panic took days to infect the market. In 2026, panic is instantaneous, global, and algorithmically amplified. Millions of investors can react in unison, not because they chose to, but because invisible systems nudged them to. The market is not just a reflection of human behavior, it is a weaponized mirror of it. The architects of 1929 survived because they understood these truths. They exploited ignorance, hubris, and emotion. In 2026, the same principles apply, but the instruments are digital, and the consequences can reach every corner of the globe before a single regulator can intervene.
Shadow players are no longer constrained by geography. The collapse can be instantaneous across continents. A misaligned algorithm in Tokyo can trigger sell-offs in Toronto, New York, and London before anyone realizes the sequence has begun. Ask yourself, are you invested in assets that can vanish overnight? Are your financial decisions influenced by narratives designed to provoke action? Are you relying on stability that may only exist in the carefully curated perception of others? Because history shows that when these variables align, leverage, psychology, concealment, the result is engineered panic. And engineered panic is not random, it is intentional. Even today, subtle echoes of 1929 are everywhere. Analysts warn of overvalued assets, social chatter inflates narratives, institutional investors hedge in ways that shield themselves while exposing the public. Digital assets, AI-driven investments, and algorithmic trading platforms magnify the effects. Panic is no longer a consequence of human error alone. It is an emergent property of engineered systems designed to amplify fear. The 1929 crash also teaches another truth. Hubris is fatal. Those who believe they control the system, whether bankers, CEOs, or tech titans, often miscalculate the feedback loops. Risk is underestimated, exposure ignored, and overconfidence compounds the crisis. The shadow players may profit, but the system itself does not forgive missteps. And in 2026, with global markets so interconnected, the feedback loops are instantaneous, leaving no margin for error. The collapse is not about one company or one market. It is about networks, systems, and perception. The Dow fell because human psychology was exploited at scale. Today, global indices, crypto markets, and AI-driven platforms are nodes in a network that can amplify panic faster than humans can perceive. A single trigger can cascade through trillions of dollars in seconds. The architecture of panic has evolved, but the rules are the same: leverage, timing, concealment, and psychology. And that is the lesson the architects of 1929 left us. They taught us that panic is not chaos, it is a tool. It can be deployed, timed, and weaponized. It can redistribute wealth, destroy institutions, and leave psychological scars that last generations. In 2026, the tool is digital, the speed is exponential, and the scale is global. Ask yourself, if the Dow in 1929 was engineered to break, what systems today are quietly programmed for collapse? How many fortunes are being protected while millions remain exposed? The answer is hidden in plain sight. The same mechanisms, the same human flaws, and now the same automated precision. History is not repeating, it is accelerating. The climax of 1929 was not a single day. It was the culmination of invisible forces, calculated moves, and engineered panic. In 2026, the same trajectory exists, but faster, digital, and more lethal. Panic can propagate across borders, assets, and platforms in ways a century ago could never achieve. And the true architects, they are already in place, waiting, observing, executing the next iteration of a cycle that has been repeating since the first Wall Street panic. You may feel insulated, you may believe technology protects you, but the truth is brutal. Engineered panic has no empathy. It does not care who profits or who loses. And if you don't recognize it, if you don't understand the architecture that creates it, you are already a participant, an unwitting actor in a performance designed to extract fear and money alike. By the time the alarms sound, it will be too late. Trust will be weaponized. Markets will move before you can react. Digital leverage will cascade, and the same psychological forces that trapped millions in 1929 will ensnare you, only faster, more subtly, and with global consequences. And so you are left with a choice: ignore history and accept vulnerability, or study it, see the architecture, and anticipate the engineered panic before it consumes the system. The architects of 1929 left a blueprint, and 2026 is the testing ground. The tools are different, the speed is unprecedented, and the consequences will be unforgiving. Because here is the truth you must face. History was never past, it was always a warning. And the drop, which began a century ago, is already programmed to happen again.